What they're saying is industrial production heavily influences investors' expectations of dividends. So the numerator, in other words. So if interest rates increase and the denominator increases and the stock, the value of the stock decreases, bonds will become more attractive. In other words, given what we've spoken about. And industrial production is currently proxied by the Dow Jones Industrial Index in South Africa. Now, getting to the Gordon growth model, I need to go back to inflation when it comes to this. Your Gordon growth model was just an extension of the present value model, given that growth wasn't taken into account as a factor, as a macroeconomic factor. So the formula for Gordon growth model is the price of a stock at time at a certain time is equal to your expected dividend over your interest minus your growth. Now the growth is G, which is derived from inflation. As I've said before, inflation influences the nominal cash flows and discount rate. And we use, in South Africa, we use the CPI to denote or to proxy for inflation. Where P is expected price of the share, that. So that's where growth was incorporated. And also your dividend, your expected dividend is equal to your current dividend today into 1 plus G, which is 1 plus your inflation factor. And your growth can be found by taking your return on equity multiplied by your retention rate. Now your retention rate is obviously how much of your equity you're going to keep in the firm to expand your business or for investment purposes. Getting on to the empirical evidence. Chen, Roll and Ross conducted research on the New York Stock Exchange from 1953 to 1983. The results show unanticipated movements in your inflation premium, your industrial production, inflation, risk premium of bonds, and term structure of interest rates are significant in explaining where the variations in your stock prices come from. So they also further found that there are potentially other macroeconomic variables that could influence variations on your share returns, but these factors only influence your variations indirectly through these above mentioned factors: industrial production, inflation, risk premium of bonds, and which is your low grade bonds and your government bonds, and the term structure of interest rates. Now, obviously, as I said before, these macroeconomic variables which were found by Chen, Roll and Ross in 1986, these are just what I'm going to use as a benchmark, because this is the most widely accepted motivation for why you use certain macroeconomic variables for your asset pricing. And then empirical evidence in South Africa. Prior studies tested for segmentation versus integration. I'm not sure if the new audience would like me to explain segmentation versus integration.
Quickly, 2 sentences.
Okay. So segmentation, basically, if I can use an example, Van Rensburg, the guy I'm going to speak about soon, Professor Paul Van Rensburg, he found that there's a dichotomy in the return generating process in South Africa. What that means is that the South African market is separated into 2 separate markets. He found that shares that mostly influenced industrial factors, macroeconomic factors that mostly influence industrial shares, and gold shares were most significant in explaining where the returns are attributed. And then versus integration. Integration would be when foreign risk factors influence domestic risk factors. In other words, globalization.
So those 2 terms are mutually exclusive, or in other words, you're saying that
mutually exclusive.
Are they mutually exclusive?
Yes.
I've read studies where they said some markets are partially segmented and partially
it's actually progressing from segmentation to integration.
Okay.
Yeah, because when you become more competitive, then all the different companies, different sectors, supposed to be influenced by a global composite of macroeconomic variables. Yeah, but currently, just a simple evidence. If you look at the apartheid times, when we are facing sanctions, we are not allowed to trade. So then you look at barrier to trade and so on, you can see that that time versus now, we are more integrated and segmented. But in our more domestic market currently, you can still see that a lot of macroeconomic forces, they're influencing, for example, the resource sectors, are totally different set of variables that are influencing the industrial sector and financial sectors. Yeah, so that is why we say that South Africa, we have a segmented market. In other words, you have two market portfolios, or for example, you are subject to two separate SML, security market lines. Just like in some other countries, that's very similar to us, is Australia. They also have a resource-dominated market, and then other kind of stocks in the industrial, or for example, agricultural, other kind of industries, they are influenced by some other set of macroeconomic variables. In Taiwan, you can actually have a separation between the ICT or electronic shares versus other shares. Okay, for example, exchange rates, for example, actually influence the two group of market sectors actually in the opposite directions. When exchange rates depreciate, then your ICT sector doing very well because it's export heavy. However, for example, traditional industries or for example financial shares, they actually like the exchange rate to appreciate and depreciate. So that's market segmentation in South Africa.
So now that we've gone over segmentation and integration, the most important part derived from my previous chapter with regards to segmentation and integration was if the market was found to be segmented, then the APT, which is the focus of my study, the APT would be sufficient in order to model basically the arbitrage pricing theory. So the arbitrage pricing theory would be a good enough approximation for testing which macroeconomic variables are most significant in explaining the variations in stock returns if the market is segmented. However, its counterpart, if I can put it in there.
So basically, originally you have the CAPM, which is a single index model.
Sorry.
Yeah.
I should have taken.
So in order to go to APV is a more appropriate proxy, it's actually come with a criticism on CAPM. Because, for example, if your market is actually not one market, it's actually two separate markets influenced by different set of macroeconomic variables, then you don't have one market, you have two markets. And they're influenced by different macroeconomic forces rather than just a single market portfolio as a whole in South Africa.
So the CAPM basically restricts you to only using one risk factor to explain everything, and APT allows you to use more than one multiple.
Yes.
So I've already spoken. Okay, Van Rensburg and Slaney in 1997, they found what we've spoken about, the dichotomy in the return generating process, where industrial shares and the gold index were used as proxies for testing which macroeconomic influences or variables most significantly influence the variations in stock returns. And then just as a note, Ward in 1994, there wasn't much to contradict the point of view of Van Rensburg and Slaney until I read about Ward 1994, who actually found that there could be integration on South African or the JSE Limited. And then why this is relevant is because it's going back to my chapter 2, or the presentation on chapter 2, the restructuring has a major effect on whether I'm going to be able to use APT or CAPM in order to test for this relationship, this macroeconomic variables or influences on South African equity returns. Should I take you through the restructuring? So
What are the newly established indices?
Newly established indices is where they reclassify certain indices in order to make trading for investors. They try to make it more seamless.
Okay, so which ones have they introduced?
They have changed the gold index, and they've changed the gold index to the resource sector.
Okay, right.
Because before was gold driven, everything's
Okay.
gold. Okay.
Mm.
But then after the mid-1990s, then the resource sector as a whole become important.
Okay.
So they reclassified everything.
Yeah.
So that happened in the early, when was the year?
2002.
2002. Yeah.
So in other words, they're trying to make the economy more integrated. And again, the motivation is to test for segmentation or integration on the JSE between 2002 and 2014. Again, we've said if it's integrated, we use the cap, we don't use the capping because it may be a more appropriate proxy, given that if there's only one market, the capping would be a good enough approximation of the model that we would use. And if it's segmented, we use arbitrage pricing, as I said again. And again, going back to the problem statement.
So basically, we think that the market is more integrated now after the JSE reform in the early
Yes, because the
2000s.
purpose of the reclassification was to keep the market more integrated.
Do you have the background and evidence? I mean,
Yes, I have the
you got all that.
Yes.
So that will be a backup of your theory. I mean, for your motivation as well, while you're examining it.
So it would be worth investigating whether the capping explains the turn generating process better than APT. And even if APT explains better, does the capping start gaining its explanative power?
Yeah.
In other words, do we move from
Yeah.
segmented market to an integrated market? Thank you.
Okay. Yeah, okay. First of all, your thesis on APT, right?
Yes.
The international evidence you started with Chandra and Ross, 1986. That is the first methodology or the first empirical evidence that started by identifying exactly what are the macroeconomic variables that are important in asset pricing. Okay, and why is it important? Because APT is solve some problem of a capping. For example, in terms of Ross critique 1970-78, it says that capping is impossible to test because of what? Because observable of the market portfolio. Because the market portfolio is supposed to incorporate every single thing, including a pen, a key, and whatever else in the world, and it's not observable. As a result, I mean, it can be a right model. However, if you cannot really identify the crucial elements in the model, how do you use it to perform asset pricing? So that is why Ross critique is actually criticizing the practicality of CAPM, and then suppose that, I mean, we should actually have a model that can be easily, for example, more user-friendly in terms of its practicality. But Chandra and Ross basically, but however, with the APT, it's a very intuitive model. However, the difficulty comes in when it tells you it's I mean, you can decompose this market portfolio into various of components that influence, we call them macroeconomic forces, that altogether collectively can be the market portfolio. Okay. So when you decompose it, for example, you can identify interest rate, inflation rate, oil prices, or tax rate, or whatever that is, exchange rate. And then those are the component macroeconomic forces that influence asset returns. So, and its most ideal form that you say the market is perfectly efficient. The asset pricing or the expected return derived from CAPM should actually be the same as APT, because the individual macroeconomic forces in APT collectively actually become the market portfolio. But the difficult thing is that, I mean, when they propose this APT model, it does not really tell you what are the identities of these macroeconomic forces. So basically, Chandra and Ross in 1986 is the first one that kind of identified the important macroeconomic forces. And then it's been tested around in the different economies, and basically these are the 5 that are the most important. Okay, but the thing is that this is too old. 1986. After 1986, there is a series of empirical evidence on APT internationally, all proven that these are the 5 important macroeconomic forces. So you have to go into it to get the more recent evidence.
To actually receive permission to do my chapter 3.
Okay, that's fine. That's fine. Yeah. Okay, so basically after that, but the important thing is to incorporate Ross critique,
Yes.
because that is basically
That's
to
my
move from
chapter
CAPM to APT. So you have to incorporate that. Is very important. Okay.
And benchmark program.
Yeah, exactly. And then there is one thing that's very important for CAPM. Is it because you mentioned about EMH and you mentioned about test of the CAPM, right? So the dual hypothesis problem.
The
Yeah.
joint hypothesis problem.
I mean, not the dual hypothesis, the joint hypothesis problem basically says that you cannot test the EMH, whether the market is efficient or not, without the reliance on an asset pricing model that's a CAPM.
So it makes it kind of hard to dispute the EMH in itself because you're going to use a lot of asset pricing models to actually say whether it's valid or invalid.
Yes, so you have to incorporate that in. So then, can I ask you the EMH, okay? There are 3 different forms. Can you just roughly explain, I mean, if you are testing the practicality of CAPM versus APT, or which one is more efficient asset pricing models, then which form of the EMH are you testing?
Which form of the image am I
Yes.
testing? Well, for my purposes, I'm looking at macroeconomic variables, so I'll use the semi-strong form because investors try to use fundamentals in that form.
In fact, it's all 3 forms, because EMH encompasses all 3 different forms. So if the market is perfectly efficient, then the asset return should actually be plotted on SML. Or for example, your error term should actually be negligible, or for example, that is your unsystematic risk should actually be able to be diversified away. So then you are essentially test whether the market is efficient or not as a whole.
Yes, because
so it's actually everything.
Test of CAPM and APT in essence are tests of efficiency.
And whatever, no matter what the reason is, because I mean, the TA can outperform the market, or for example, FA can be used to outperform the market, or whether the investors use inside trading or inside information to outperform the markets. Basically, any deviation from the SML is basically encompassing of 3 different forms. So if an asset pricing model basically is short at line. When you have SML, you have X and Y, okay, the beta and the expected return. But then, for example, if you have a 2-factor APT, it's actually in a 3-dimensional diagram. You still draw that line anyway. So, in essence, all the assets should actually be plotted on that particular line. Okay, no matter how many factors you are using. So, you are actually testing the EMH, whether the market is efficient or not as a whole. Yeah. Okay, and then according to your macroeconomic forces influencing the DDM, it will be better that if you explain it in terms of more interpreted, than, for example, try to describe it. So if I would start it with explaining basically to price any assets, okay, especially as a stock. I mean, the one that we mostly use is basically the golden dividend discount model, which is D1 divided by K minus G. So then I will put that as a center and try to explain, for example, inflation will influence your K or G, or for example, the dividends or future growth and so on.
It is in my head.
Yeah. So if it's a center, so don't try to explain top-down approach. If you can interpret something, don't describe it. You elaborate it, you interpret it. So if you started with a formula, then I can see that you can start looking at the factors that will influence your required rate of return K, okay, estimated by the CAPM. That will be your inflation rate, your interest rate, and so on, and other kind of things. However, the factors that will influence G, the growth rate of the future dividends, then it will come into effect something like industrial production and so on. You see, and your dividend payouts, there are other factors. So essentially, all the 5 factors, the macroeconomic forces identified by Chen Rou and Ross in 1986, basically are all the factors that will influence the 3 different variables in your dividend discount model. So try to interpret it rather than describe it. Yeah, it will be a better explanation. And then, yeah, I think that's it. Yeah. Overall, I think it's well motivated, and your problem statement look quite good. Yeah.